Unless you have been hiding under a rock recently, you have heard the tale of GameStop, or GME, the ticker symbol for the video game retailer GameStop in WallStreetBets, the 8 million strong Reddit community of insurgent stock investors. You also know about WSB WallStreetBets' successful push to send GameStop soaring in just 2 weeks from under $20 a share to an all-time high price over $350 on Wednesday, January 27th, putting hedge funds like $12 billion giant Melvin Capital Management, which had bet against the stock, in dire jeopardy. You also know that GME, GameStop's epic rise, was halted in its tracks the next day by the sudden announcement on Thursday, January 28th, by a number of stock trading platforms, chief among them Robinhood, that new purchases of the stock would be temporarily suspended. This left retail investors, regular people who purchased GME or GameStop, holding the bag, and gave large institutional traders a chance to unwind their positions and mitigate their losses. Now is a stark look at how many financial markets like the New York Stock Exchange NYSE work today, and how powerful incentives and overlapping interest among Wall Street giant trading firms combine to disadvantage retail investors among them. GameStop, or GME, originally came up in the WSB forum months ago as a standard undervalued, worth looking at opportunity. Shares had been hammered along with many other retailers to under $3 a share during the COVID-19 pandemic. But towards the end of 2020, it became apparent that large hedge funds had been betting against the stock heavily, putting massive amounts of money down on the prediction that GME or GameStop would sink even lower. The WSB subreddit realized that this created an opportunity. Betting against the hedge funds could generate potentially immense returns while striking a satisfying blow against the Wall Street establishment. In early January 2021, the campaign went viral on social media, causing GME or GameStop's price to skyrocket over 2,000% in 1 month, hitting an intraday high on January 27th of $483 and saddling the trading firms who bet against it with billions of dollars in losses. The very next day, January 28th, Robinhood and several other brokers took the unprecedented action of severely restricting or completely eliminating the ability of regular people to purchase GameStop or GME and a handful of other stocks that have been trading on WSB. It's also worth noting that these brokers restricted only purchases, not sales, of these high-flying stocks, and the platform in question were ones that specifically catered to small retail investors with populist messages such as "let the people trade." The purchasing freeze cut off buyers for GameStop or GME while allowing sellers to unload. As a result, GME's price predictably came crashing down, falling 44% to $193 when the market closed that day, and continuing to fall thereafter. As the market closed on Friday, February 5th, GME was down over 80% from its high the day before purchasing restrictions were imposed, to less than $64 a share. Here's where things start to get murky. According to Robinhood and other discount brokers, the reason they shut down trading was because of financial institutions handling the actual execution and settlement of stock transactions had suddenly announced an increase in the collateral needed to authorize purchases of GME and other stocks being promoted on WSB and social media, doubling or even tripling the required deposit required. Robinhood claimed that to meet this unexpected collateral demand, it was forced to raise $100 billion in additional money from its investors basically overnight, which in turn made it clear that allowing trading to continue in those stocks was unsustainable for its business. In short, they said, the purchasing freeze wasn't due to collusion or market manipulation, as some have alleged. It was simply a pragmatic response to an existential threat. But as much as Robinhood had to cover collateral, could anything further be going on? Was there really no way to allow trading of GME or GameStop to continue? And why exactly was the collateral requirement imposed on Robinhood and other brokers for GME purchases raised so dramatically? Answers to these questions is not just a matter of idle curiosity, they are of enormous importance to millions of small investors who have put their savings into stocks and to our faith in financial markets as a whole. And to answer them, we first need to understand who the key players in this messy chronicle are and what roles they play in the stock market at large. First, there are the hedge funds, the most visible of which in the GME saga is Melvin Capital Management, managed by Gabe Plotkin. Back in 2001, Plotkin's first job after graduating from Northwestern University was Citadel LLC, a name you'll want to remember. After he left Citadel, Plotkin eventually ended up as a top trader at the hedge fund SAC Capital, founded by Steve Cohen, who took him under his wing. In 2013, SAC Capital agreed to pay a $2 billion fine for insider trading, the largest in U.S. history. As a result, Plotkin decided to strike out on his own, receiving an initial investment of $200 million from his mentor Cohen to help him start Melvin Capital. That $200 million turned out to be a fantastic investment. Melvin Capital has generated returns averaging around 16% per year since its inception, and earned an excess of 40% in each of the past 2 years, with a strategy heavily emphasizing short selling, something that Plotkin has said is an intense focus of his firm, making up 70% of its profits. Now, what is short selling? Though you've probably read the definition a million times by now, short selling is the practice of borrowing shares, selling them, and promising to buy them back later when the stock is presumably going to be cheaper. Short sellers make a profit on the difference between the price at which they borrowed and the one at which they eventually sell. The risk is that if the stock goes up, especially if it goes up sharply, brokers will demand that shorts cover their positions, forcing them to buy shares at a loss to make good on what they have borrowed. If you buy stock in traditional fashion and go long, the most you can lose is your initial investment, assuming the stock goes to zero. However, if you short sell a stock, there's no limit at how much you can lose if the stock keeps on going up. Because whatever the price is, you eventually have to buy to cover your short position. When short sellers start to buy stock to cover their positions, it can set off a mad scramble among other shorts to the same, sending the stock price even higher in a kind of death spiral. This is known as a short squeeze. In the case of GME, Melvin Capital, and other hedge funds, they had reportedly shorted the stock so heavily that more shares were borrowed than even existed for trading. As of December 31st, 2020, GME was reportedly shorted 136%, meaning that for every share of GME listed to trade in the stock market, nearly 1.5 shares were borrowed to short. Melvin Capital had one of the market's biggest short positions in GME. The WSB campaign squeezed Melvin's short position, forcing the hedge fund to repurchase shares at a considerably higher price than it had paid to cover its bet. As a result, in January, Melvin Capital reportedly suffered a loss of 53%, over $4 billion. But as the stock continued to rise, another even more dire situation unfolded for other major players in the financial establishment. A growing number of WSB traders began embracing the strategy of purchasing options on GameStop stock rather than the underlying stock itself. By buying call options, the right to purchase GME at a certain price, they were able to get substantial leverage on their investments. Traders focused on call options with short expiration dates that were sharply out of the money. Example, contracts to purchase shares at $60 when the stock was still in the $40 range, which, as might be expected, were extremely cheap. On January 4th, GameStop's price was $17.25. An investor looking to profit from the short squeeze may have wanted to buy call options with a very short expiration date, say January 15th, and the deepest out-of-money strike price possible. For example, on January 4th, GameStop call options with an expiration of January 15th, and a $30 strike price, the deepest available that day, with good volume and pricing, cost just over 12 cents at market close. As GameStop share price skyrocketed, these previously cheap, deep out of the money options became very valuable. For a cost basis of only 12 cents, these options were worth approximately $9 on January 14th, representing a 7,500% return in less than 2 weeks. In a less risky example, another investor looking to play the short squeeze may have bought options near the money with a longer expiration date. Say calls with a $20 strike price expiring on April 16th with a cost around $4.15 at market close on January 4th. Before the end of January, those call options would have been worth over $300, representing a return of over 7,000% less than a month. Utilizing strategies like this, Roaring Kitty, one of the earliest GameStop supporters on YouTube and WSB, reportedly saw his $53,000 investment in GameStop stock and options rise to $48 million at its peak. Every transaction has to have another party on the other side. Short sellers need someone to lend them stock, usually their broker-dealer. Call option purchasers need someone to service the house for their bet by writing the option. The house in this case is often the market maker, a financial entity that has been designated as a kind of central hub for buying and selling a particular stock, ensuring that the market for its shares is always liquid. Market makers traditionally make profit from the spread they offer because of the price at which they're willing to buy stock and the price at what they're willing to sell it. However, in writing options has become a booming source of revenue for market makers, growing alongside the derivatives market as a whole, which exploded in size the past decades. Market makers use market data on their covered stocks to price option contracts for an expected profit. And in order to account for the fact that their pricing cannot be perfect in all market scenarios, they also hedge their option contracts. In the case of writing call options, this means that market makers buy the underlying stock. With thousands of people buying GameStop options, the market makers behind the stock found their risk exposure growing. As the price of GameStop rose, the cost of paying out the options they had written soared, forcing these market makers to purchase GameStop stock to bolster their hedge. And of course, market makers themselves joining the buying frenzy only see GME's price even higher. This situation where market makers are forced to buy the stocks underlying their options due to a rapid increase in the stock price, quickly driving previously out of the money options, and the money is called a gamma squeeze. While the GameStop short squeeze put a few hedge funds like Melvin at risk, the gamma squeeze that occurred when the stock's entire option chain went in the money overnight threatened a much larger and more fundamental part of the financial establishment. Market makers exist in traditional exchanges to ensure liquidity and trading. It is far easier and faster to have both buyers and sellers trade with a single large entity that has a lot of shares than it is to try to match individual buyers and sellers, and thus risk failure to find counterparts to offer transactions, which would cause trading to grind to a halt. To ensure that there are market makers for its thousands of securities, the NYSE, New York Stock Exchange, still the largest stock market in the world, accounting for a third of all global stock transaction volume, employs what is used to be known as specialists, but are now referred to as DMM, designated market makers, a privileged and elite designation held by a relatively small number of huge entities who match trades and provide liquidity for not just a handful of stocks, but hundreds or thousands of them. The very largest of the NYSE's DMM, a company called Citadel Securities. Citadel is the largest DMM on the NYSE. Its promotional material brag about its skill. It serves over 2,000 listed NYSE companies representing $16 trillion in market cap, including 8 out of 10 of the largest NYSE listings of 2020 and 80% of all listings in 2021. It was huge when it launched its DMM business in 2016. It got even bigger in November 2020 when it purchased its rival IMC's DMM business, solidifying its hold on the NYSE. And as you might have guessed, given how this narrative is shaping up, Citadel is the DMM for GameStop, the DMM for GME, GameStop's NYSE listed stock, and thus the writer of many of its option contracts. The gamma squeeze may have been a knife at Citadel's throat. Citadel may have been desperate to do something to stop the flood, but what could it do? For one, it could put pressure on brokers to curtail purchases of GameStop stock and options. Many have reported the unique relationship that Citadel has with Robinhood and other discount brokers. It pays them billions of dollars in order to serve as their preferred market maker. ensuring that the millions of orders executed on those platforms are directed to them rather than a competitor. By making huge payments for order flow, PFOF, Citadel Securities has made itself the largest source of revenue for Robinhood, which launched its Stock for the People brand by pioneering the idea of zero commission trading. Robinhood does not only earn money directly from most of its 13 million plus retail investors, but it earned nearly $1 billion in 2020 by selling access to those investors' trades to market makers, with hundreds of millions of that coming from Citadel. Robinhood is not the only broker to earn money by selling order flow. Of course, all discount brokerages do. However, Robinhood generates the most transactions and thus earns by far the most PFOF revenue. It should be noted that after journalists broke the story of Robinhood's hundreds of millions in PFOF earnings, the SEC took action against Robinhood, charging it with failures in its regulated duty to perform best trade execution for clients and for misleading customers. The fine that Robinhood paid for this was $65 million against nearly $1 billion in 2020 PFOF revenues. It should already be clear that the market is deeply unfair. You can imagine how a company like Citadel, which controls a huge percentage of trades on the NYSE and also has every major brokerage feeding it its data for it to trade against, has exceedingly subtle and powerful market advantages. And indeed, in 2017, Citadel paid about $23 million to settle charges with the SEC of providing unfavorable trades to retail investors. And as recently as July 2020, Citadel was charged with trading ahead of their clients by FINRA, the private regulatory authority that the financial services industry voluntarily created to police itself. They were fined $700,000 for this behavior. So it's easy to assume, and many people have, that Citadel exercised some pressure on Robinhood to halt purchase transactions of GME or GameStop, using the very big stick of being the primary source of the startup's revenue. But Citadel itself denies it. According to a statement made to CNBC and other media, Citadel said it has not instructed or otherwise caused any brokerage firms to stop, suspend, or limit trading, or otherwise refuse to do business. And Robinhood also denies it. And even other online brokers who didn't make the decision to halt buying or didn't have to halt for as long, nor with as many orders, explains the situation in similar fashion. The collective party line was clear. Brokers and market makers were not to blame. It's all the fault of the new collateral requirements that clearinghouses put on them to a point where no one could possibly cover them and remain in business. So what is a clearinghouse? And what role does it play in the stock trading ecosystem? Trades on brokerage apps look like they happen instantly. Click a button, digital money disappears from your digital wallet, and your digital portfolio tells you that you're now the proud owner of shares of Acme Holdings. But the fact is, regardless of how snappy the UX is, trades don't actually happen when you see them on screen. There's a complicated process by which Robinhood and any other broker legally confirms that shares exist to be sold, that the ownership of those shares is valid, that the owner is willing to transfer them at the price quoted, and then the cash or credit that you have presented as having in your account is sufficient to cover the price that has been set. The process, which is called settlement, remains invisibly and most of the time without issue. The Governance Security and Exchange Commission, SEC, which regulates securities trading, set a fixed settlement period for obligations to be met in transfers made, which is currently T+2, 2 days after a transaction. That was reduced from T+3 in 2017 and T+5 in 1993, reflecting the reality of our increasingly digital financial infrastructure. With paper trades really changing hands, even 2 days seems like an absurdly long period of time for trades to be settled. The whole process of checking, validating, and making formal transfers of securities is handled by clearinghouses for a small fee. As part of the process, clearinghouses also require collateral deposits against the values of the securities traded. And yes, they do raise those collateral requirements when the securities in question are in a very volatile cycle, because it's understandably harder to pin down what they're worth and rather regulatory restrictions are being followed when a stock is soaring, collapsing, or jumping up and down. And here's the twist. Robinhood, the broker that more than any other is at the center of the GameStop purchasing halt mess, doesn't use an outside clearinghouse. They actually built their own state-of-the-art trade clearing system back in 2018, and they moved to vertically integrate their trading system to lower fees and capture more data on what their account holders are doing. But that does not mean they were not exposed to collateral requirements. It just means that the entity exerting the pressure on them represent a deeper layer, and arguably the deepest layer of our securities trading ecosystem. While clearinghouses do the busy work of validating trades, they don't hold on to the underlying securities themselves. The scale of transactions they're managing is so huge, trillions of dollars, that it represents far much risk for any individual clearinghouse to bear on their own if things go sideways. The business of holding on to the actual shares and managing their financial transfer is handled by something called Central Security Depository, of which the very largest, the one that holds the shares and ultimately settles the trades of virtually all stocks on the NYSE, is a wholly owned subsidiary of an entity called the Depository Trust and Clearing Corporation.